Hey everybody, back with another ETF review, and today we're going to be looking at the SPDR S&P Dividend ETF from State Street, or SDY for short. Wanted to look at this because I talk about a lot of funds that are very similar to this, and this might be another option if you're interested in things like SCHD or other dividend appreciation ETFs. It's good to go over all of the available options and weigh them all equally. So first of all, what is this fund? What is SDY? We can see here that it does have its index, and the index screens for companies that have consistently increased their dividends for at least 20 consecutive years and then weighs the stocks by yield. What that essentially means is it's looking for companies that are really doing dividend appreciation. They don't quite have to be dividend aristocrats at 25 years, but 20 years is still good, and that does have some implications that we will talk about later. Moving on to the expense ratio, currently sitting at 0.35%, right in the middle really for passively managed funds. Something like SCHD would be a lot lower than that, really dropping under the 0.1%, but 0.35% isn't bad. It's not crazy. It's not the 0.5% or the percent you see from some passively managed funds, and definitely nowhere near the actively managed fund rates that you see that are really out of this world. It's also a very large fund, as we can see here, with multiple billions of dollars under management, so there's probably going to be a lot of liquidity, probably going to be very easy to trade this, buy it when you want to, get out when you want to, no issues there. Going down to the yield, we can see that currently the yield sits at around 3%, just under that. That's pretty much expected for a dividend appreciation fund right now. You're doing a little bit better than twice the S&P, or right at about twice what the S&P is doing, and a lot of your dividend appreciation funds are sitting between 2.5% and 3%. That's really, if you're looking for a dividend appreciation, that's about as high as you're going to get. You're not going to get much more there, so that's pretty expected. Moving on to the holdings, we can see their top 10 holdings here. Pretty much names in the fund that everyone knows: AT&T, Exxon, Chevron, IBM, Amcor, AbbVie, Realty Income. These are just a lot of things that everybody knows. Now, some interesting things about these holdings are that, as we saw, the holdings in the fund have to increase their dividends for at least 20 years. Their top holding, AT&T, is going to have to be sold off by the fund next year when the dividend cut comes, and that might happen to some other companies. I'm not going to go through all of the holdings, but just know that if you see any company that's going to have a dividend cut and they happen to be a part of this fund, they will have to be cut from the fund for the fund to meet its rules and to follow its index. So just keep that in mind. Moving down to the sectors, we can see here mostly financials, consumer staples, industrials, and utilities, and then we just go down to information technology at the bottom. Some very good diversification in some ways here, with consumer staples, which you all know I'm very big on, some industrials and utilities all holding about 14 to 15% of the portfolio, and the rest of the holdings being in the mid-single digits, really. Now, since this is a dividend appreciation fund and financials tend to increase their dividends as economies do well, financials do hold the highest allocation here. Thankfully, it's not huge. It's not even 20%, but just know that if there is a big market downturn, this section of the portfolio is going to do very poorly. But whereas things like consumer staples will probably do not as poorly, so a good bit of diversification, some weighting there that helps. Moving on to its performance, let's take a peek at how it's been doing over time frames. We can see here, thankfully with a nice graph, that over the 10-year, we've been looking at about a 13% return. Over the 5-year, about a 12% return. Over the 1 year, doing 33% for obvious reasons. But really, not too bad. Since inceptions, it's done about 9% over the last 16 years. Which is really about the same as the S&P over the long term. You can do between 7 and 11%, and if you want to do that, roughly 10%, but dividends or income, you want that to be a part of that return, this could be a good alternative for you. If you're not just looking for capital appreciation, but you're looking for capital appreciation with some way to get income, or if you just want to reinvest dividends for compounding, this could be a good alternative to just looking at the S&P 500. Now let's go ahead and do our back test. For this, we'll have SDY, and we'll put it up against what I think is its prime competitor in SCHD from Schwab, and up against the S&P 500 as a whole, as our control. And as we can see here, kind of an interesting graph. We can see that all three funds really did the same until 2017, then again really up to 2019, very similar. When we had the crash in 2020 is really where the funds started to diverge. The S&P, of course, took off after the crash. Everyone's aware of the insanity that ensued, but it also lagged behind SCHD. Some reasons for that are going to be the holdings and the weightings. SCHD, I think, has somewhat better holdings. For example, it doesn't have AT&T, which anyone who watches my channel knows that I tell people to stay away from. But it lagged behind a little bit there. As we can see, over that roughly 9-year period, you're doing about, if we do about 10% less than the S&P and about 5 to 6% less than SCHD. This isn't terrible by any means. I mean, your compounded annual return is still, 13%. That's not bad at all. It's not 16%, which would be better, or 15%, but it's still pretty great. The one issue that I would say is that the drawdown was quite severe compared to the other ones, especially compared to the overall market. Really, you would want, if you are picking and choosing stocks against the wide market, you'd want your drawdown to be, better, because you are picking stocks that you think are going to be resilient and able to raise their dividends, which SCHD also had that issue as well, so just keep that in mind. But overall, I mean, it's not a huge difference when you really think about it. It's really just been over this 2-year period, and what is 2 years to the market? Nothing. This could all change tomorrow, in the next month, in the next year. Dividends could take off while the wide market does poorly, or it could continue to change. Just keep that in mind. But again, if you held this, you would have been making money quite well. Again, 13% is nothing to shake a stick at. So looking at this fund, who is it for? Should you be looking at it? Should you be buying it? Is it something to think about? If you are interested in dividends, dividend appreciation in particular, this is definitely something to look at. Again, I would probably say that SCHD would be better, but if you like the holdings here better than SCHD's, because they are somewhat different. SCHD's top 10 is quite different from this, actually. If there are holdings in here that you like more, but you don't want to invest in them individually, you want it to be in a fund, this might be something to look at. If, again, as I said before, if you're looking to do that roughly what the market does, about 9, 10, 11%, but you want some of that to be in dividends, this could be a better alternative to just investing in something like VOO or SPY or something of that nature. It really just comes down to a matter of choice. Do you like the companies here better? Do you like the companies there better? Are dividends what you're looking for? Things like that. This definitely isn't a bad choice. It's one of those things where I think it's fine for what it is. I just think there are possibly better choices if you're looking for, say, the lowest expense you can get or the highest total return. But again, if there are certain companies in there, if there are certain things about the fund that you like, this isn't a bad choice by any means. I hope that helps, and thanks for watching.